Welcome, curious minds, to another deep dive.
Great to be here.
Today, we're really getting into the latest from Maruti Suzuki India Ltd. We're looking at their Q1 results for the financial year 2025-26. So that's April to June 2025.
Yep. And we've got the official financials, the press release, their investor presentation. Quite a bit to go through.
Exactly. So our mission, as always, is to cut through those numbers, figure out what's really going on and what it means for the company. And, for you listening, think of it like a financial detective story.
Absolutely. We'll look at the raw data, connect sales to profit, and flag some key influences this quarter, plus some hints about what might be coming next.
Okay, let's dive right in then. The big picture first. Sales volume, revenue, profit. How did Maruti Suzuki do this quarter compared to last year? Give us the quick headline.
Well, it's actually quite a mixed picture when you look closely.
Okay.
Total sales volume was 527,861 vehicles. Now, that's up, but only just 1.1% year on year.
Just 1.1%.
Right. But then net sales, that came in at INR 366,247 million, which is a pretty solid 8.1% jump from Q1 last year.
Okay, so sales value up much more than sales volume.
Interesting.
And profit.
And the net profit, despite some, underlying shifts we'll definitely get into, it rose to INR 37,117 million. That's a 1.7% growth compared to the same quarter last year.
Right. INR 37,117 million, up 1.7% from about 36.5 billion last year.
Exactly. So a slight profit increase, even with that very modest bump in overall vehicle numbers.
That profit increase is intriguing. I mean, only 1.1% more cars sold, but profit's still up. It seems like there's more to it than just volume, right?
Definitely.
To really understand this,
Yeah.
we need to break down where those sales came from. This is where it gets, well, really interesting, I think.
Yeah, if you connect it to the bigger picture, the split is definitely the story, domestic versus exports.
Okay.
So while overall volume was up slightly, like we said, domestic passenger vehicle sales, they actually declined, down 4.5% to 430,889 units.
Down 4.5% domestically. Wow. That does suggest things are a bit sluggish here in India, like the company noted.
It certainly points that way.
So if domestic sales were down, what made up for it? How did they get that overall 1.1% increase?
Well, the counterweight was exports.
Right.
And it was a strong counterweight. Exports surged by 37.4% compared to last year.
37%.
Yep, reaching 96,972 units. That huge growth in exports was absolutely key. It offset the domestic drop and got them into positive territory overall for volume.
That's a massive offset. It really highlights the importance of their global strategy.
Mm-hmm.
But focusing back on domestic for a second, where did they see the shifts? Which types of cars?
Well, within those domestic numbers, there were some pretty clear shifts. The mini segment, think Alto, saw a really big decline, 36.6%.
Ouch.
Yeah. It's now only 4.5% of their domestic sales. The compact segment Swift, Baleno also dipped, down 6.3%. That's still their biggest chunk at 41.1%, though.
So the traditional small car base is definitely shrinking.
It is. Combined, mini plus compact were down 10.6%. Meanwhile,
Yeah.
UVs, utility vehicles like the Brezza or Ertiga, they held relatively steady, only a tiny 0.8% decline.
Right.
And they still make up a huge 37.6% of domestic sales. So, it raises the question, how does this move away from smaller cars towards UVs shape their future plans?
It's a clear trend, isn't it? Fewer small cars, more focus on UVs. That must be driving some strategic thinking inside Maruti. But okay, let's circle back to that profit number again. Net profit up 1.7%, domestic sales down, overall volume barely up. How did they pull that off?
Right. It seems like a bit of a puzzle.
It does. What's going on with their costs and margins? What do the ratios tell us?
This is where, the numbers get really revealing. While net profit was up slightly, the operating EBIT earnings before interest and taxes actually went down.
Down how much?
It declined by 18.9% year on year, came in at INR 30,578 million.
Okay, wait. Operating profit down nearly 19%.
Exactly. And if you look at it as a percentage of net sales, the operating EBIT margin dropped from 11.1% in Q1 last year.
Down to 8.3% in this quarter. That's an adverse move of 280 basis points, or 2.8 percentage points, a significant hit to their core operating efficiency.
Okay, now I'm really confused. Operating profitability down significantly, but overall net profit slightly up. How does that work? What explains that difference?
This is the aha moment, you could say.
Okay, I'm ready.
The company points to a few things. On the negative side for margins, Commodity prices weren't helpful. Neither was foreign exchange movement.
Right, typical headwinds.
Plus, higher sales promotion expenses may be trying to boost those domestic numbers and costs related to the new Carcosa plant kicking in.
Okay, so costs up, pressures on the operating side. What pulled it the other way for net profit?
Two key things counteracted those negatives. First, they mentioned diligent cost reduction efforts elsewhere. Standard practice, but important.
And the second?
And second, critically, a significant increase in non-operating income.
Non-operating income, like investments or... Exactly, things outside the core business of making and selling cars. As a percentage of net sales, this non-operating income jumped from 2.9% last year's Q1 to 5.0% this Q1.
Wow, from 2.9 to 5.0%? That's a big jump.
It's a positive shift of 210 basis points. And that higher non-operating income was crucial. It boosted the profit before tax and therefore the net profit, despite those challenges in the core operations.
Okay, so the magic trick, if you want to call it that, was largely down to this boost from non-operating income papering over the cracks in operating margin.
That's a fair way to put it this quarter, yes. It really cushioned the blow from the operating side.
Interesting. Makes you wonder about sustainability, but definitely explains the numbers for Q1. Okay, beyond the financials, what else stood out from their reports this quarter? Any big strategic stuff or regulatory changes we should know about?
Yeah, absolutely. Two important points to mention. First, there's an internal restructuring thing. The board approved a scheme of amalgamation back in January. It involves merging Suzuki Motor Gujarat Private Limited, which is a wholly owned subsidiary, into Maruti Suzuki. This got the NCLT, the National Company Law Tribunal, approval in June.
Right.
Though, it still needs other regulatory sign-offs, but it's a move towards simplifying their structure.
Okay, internal housekeeping. Makes sense. What's the second point?
The second one is potentially more impactful looking ahead. It's the notification of new environmental rules, the Environment Protection End-of-Life Vehicles Rules, 2025. They call them the ELY rules.
End-of-life vehicles. So, about scrapping old cars.
Precisely. These rules came into effect on April 1st, 2025. They place extended producer responsibility, or EPR, obligations on manufacturers like Maruti.
Okay. What does that mean in practice?
It means they're responsible for ensuring vehicles get scrapped properly at the end of their life. The mechanism for this is supposed to be purchasing EPR certificates through a new centralized online portal.
But let me guess.
Yeah, the challenge is that portal isn't developed or operational yet.
Oh. So the rules are in effect, but the system to comply isn't ready.
Exactly. And without that portal, there's no clarity on how producers register, who the certified scrappers or vendors are, how the certificates will be priced, or even how compliance will be measured.
So, what does that mean for Maruti right now? They just wait.
Well, it means they currently can't reliably estimate the financial impact. They can't figure out the potential cost or range of outcomes from these new obligations.
That sounds like a big uncertainty hanging over them.
It is, and it's significant enough that the statutory auditors, Pricewaterhouse Chartered Accountants, LLP, specifically drew attention to it in their limited review report. They mentioned this lack of clarity in Note 5.
Did that affect the audit opinion?
No, importantly, their overall report remained unmodified. So they flagged the uncertainty, but it didn't stop them from signing off on the financials themselves. Still, it's a clear indicator of a future challenge.
Okay, so wrapping this all up then. Maruti Suzuki's Q1. It feels like a story of navigating different currents.
I think that's right.
Sluggishness at home, offset by really strong exports, core operating profit under pressure from costs, and maybe weaker domestic demand.
But salvaged on the bottom line by a big boost from that non-operating income.
Right. And then you've got this internal restructuring happening and this big question mark hanging over everyone about these new end-of-life vehicle rules and their eventual costs.
Exactly. It paints a picture of resilience, definitely. Adaptation, too, focusing on costs, pushing exports. But yeah, the ELI rules are a significant unknown, not just for Maruti, but for the whole Indian auto industry.
So for you listening, what's the takeaway? Well, think about how a huge company like this juggles challenges in its home market with opportunities abroad, and how new regulations, even when the details aren't fully sketched out yet, can suddenly inject major uncertainty into a well-established industry.
Yeah, it's fascinating.
And specifically for cars, it makes you wonder, how might these environmental responsibilities, once they're quantified, change things? Could it affect manufacturing?
Yeah.
Car prices? Maybe even how we think about owning cars long-term?
Definitely questions worth considering.
Something to really mull over as this ELY situation develops.